Money FM 89.3, best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. Let's take a look, and we've got some green on the screen, at least for the S&P 500, squeezing out a small gain of 0.02%, closing at 6,380. So pretty much finishing near the flat line as traders look past the trade deals that have been announced between the U.S. and the European Union. Also, looking at the S&P 500, it hit a fresh record shortly after the opening bell, but the index did not seem to be moving any higher as traders continue to watch out for the data to come as well as the earnings. The Dow Jones Industrial Average slightly underwater by 0.1%, while we have the Nasdaq Composite adding 0.3% to a new record high. Let's check in now with Ryan Detrick. He's the Chief Market Strategist for Carson Group. Ryan, good morning. How are you doing today?
Hey, I'm doing well. Thank you for having me back, Ryan. In the U.S., we've hit 6 new all-time highs in a row in the S&P 500, so can't complain.
Can't complain, but are you surprised by the strength they've been seeing in the markets?
Well, not really. We've expected a summer rally. I mean, there's so many different ways to look at this. I think the reality, like you just said before I came on, earnings have been really solid, right? Not just in the U.S., but globally. But we've got stronger earnings than expected, but also profit margins here in the U.S. are hitting new cycle highs. We call those the dual tailwinds to a bull market. And, the U.S., about 9% for the year, approximately. Now, we all know S&P was down 15%. For the year back on April 8th. So that's a wild round trip. But at the same time, to us, the trade war is likely over. We've got an economy that's solid. There are some cracks, yes, but this is a global bull market. I mean, look at Japan, right? First new high in 35 years. There's a lot of countries doing well, and new highs are just part of a bull market.
Yeah, that's interesting to wrap a head around, right? Things are getting more expensive. You have tariffs as well, not just 10%, it's maybe even higher, 15 or more. Things are going to get more expensive for businesses, but yet it's just pushing higher.
Well, you're right. And, like 3M, right, large company obviously here in the U.S. and globally for that matter. I mean, they came out just last week and actually issued guidance above what they issued at the start of the year. All right. So, it's a messy crystal ball, I'll admit, but the reality is what corporate America is still saying here, this earnings season, solid. Now, I know, Apple's coming out, lots of other big companies are still coming out, but so far, it's been impressive, and that's the big question about tariffs. Are they going to create continued higher prices, or are they more of a one-time tax with a one-time kind of jump in pricing? We're kind of the latter. We think it's more of a one-time jump in pricing. And you talk about inflation for a second here in the U.S., the consumer-level pricing and producer-level pricing 2 weeks ago both came in fairly tame. And yes, things like furniture and toys and sporting goods, those all cost more like you'd expect with some of the higher tariffs. But then the other side of things are areas like rent and shelter. Those are really starting to improve, kind of offsetting that. So we're in the camp that the Fed probably should have been cutting already. The Fed's going to have a meeting on Wednesday here in the United States. Probably not going to do anything. But maybe they're going to set the stage for a cut this September.
Yeah, talking about rates. So let's look at the U.S. dollar. We've got Donald Trump last week talking about how he's going to be pushing for a weaker currency. And that's where he is looking at how that's going to be a tailwind for companies. How much is that going to help markets?
Yeah, put it this way, it's been helping so far this year, we think. I mean, the dollar, it had one of its worst first halves ever, for the weakness it had. But then you take a bigger picture look, it's trading where it was, 6-7 years ago. And it's kind of in this big old range. And the reality is a lower dollar tends to help multinational companies. It tends to potentially help those earnings overseas. But from an investments point of view, a weak dollar also historically, meant global markets do a little bit better. And that's clearly what we're seeing. The U.S., like I said, up 8 or 9%, but that's actually one of the laggards on the year. We think the U.S. plays catch-up to a degree the second half of this year. But the reality is a diversified portfolio. It's kind of a dirty word the last couple of years because, obviously in the U.S. or U.S.-centric, but a lot of people just invest in the U.S. and did well, right? But this year is a good reminder of why you should have a diversified global portfolio is other parts of the globe are doing well, and that lower trending dollar is part of it. One more comment on this. People said people are selling the dollar because they don't want to own U.S. assets. And I'm not so sure it's that simple, because in the Treasury, we just had data came out last week for the previous month. And what we've seen since the tariffs started, all the trade wars started, foreigners are actually buying more U.S. debt and buying a good deal of U.S. stocks. So I don't think the U.S. has kind of lost its, kind of gold standard, if you will, for a lot of investors. We're still seeing foreign investors buying U.S. assets, and honestly, that's probably a good thing for U.S.-based investors.
All right, Ryan, talk about the demand for U.S. assets. What are you seeing in terms of market breadth? Are you seeing that going across the board?
Yeah, one of the things we're hearing a lot about is how market breadth is weak, suggesting, there's only a handful of stocks going up. It's all big cap tech pulling things higher. We adamantly disagree, because when I look at it, first off, all 11 sectors in the S&P 500 are up on the year. Okay, yes, some are up more than others. That's how every single year works. But then if I look at the S&P 500 equal weight index, so there's 500 stocks in there. Like the name would suggest, they're all weighted equal, because if we know S&P's market cap, so that's how that works. But the equal weight just last week hit an all-time high. So you've got various advanced decline lines hitting new highs. You've got the equal weight hitting a new high, and you've got all 11 sectors higher. Oh, and then like we talked about the question or two before, global markets are strong as well. So to me, this is not a weak market breadth market. This is actually fairly strong, and that's really, I think, a nice sign for more active investors and active managers out there, as there's a lot of potential areas you can do quite well in.
Yeah, I'm not sure if this ties into what you're seeing as well, the meme stock mania that's returning. Sign of risk appetite with Krispy Kreme, GoPro, Kohl's, and names most people would not look at most of the time.
No, you're right. I mean, I guess American Eagle Outfitters was in there also, and there's probably a couple others. And that's a great point, because we all remember in 2021 when GameStop was going crazy and AMC, and I'm sure there were others. That kind of was near the end of that bull market, right? We peaked in late 21, market rolled over, and had a vicious bear market here in the United States in 22. But when we look at things, we're just simply not seeing over-the-top optimism. You could say there are pockets of optimism with the meme stocks, but just simple like, the number of bulls and bears in various polls. We've seen the number of bulls drop 4 weeks in a row. We've seen active managers decline in terms of their allocation to U.S. equities a couple months in a row. And then there's a Gallup poll that just came out last week or so in the U.S. They looked at investors, and it said 6 out of 10 investors actually are more worried about the future, and most of them expect more volatility and weakness to come. So to me, with the market making new highs here in the U.S., those aren't signs of over-the-top optimism. So we're watching the meme stocks, obviously, but the reality is, it's still a bull market, and people aren't really jumping on board yet. We like that.
All right, Ryan, as we head towards August, what's going to be the playbook for you? What are you going to be leaning towards?
Yeah, so let's just remember this. So obviously, U.S. S&P 500 gained 11% in May and June. Well, the best 2-month rally ever in those 2 months. I know July's not over yet, but we're up about another 3%, give or take. So the question becomes, okay, what can happen in July? Let's all just remember this. July historically is one of the weaker months. July in a post-election year like we are now is actually the second worst month. And July in a post-election year, when you have a second-term president, happened 6 times since 1950, never been higher. So this is just one of those things to think. Doesn't mean it's like we have to crash or anything. I'm not saying that at all. But I'm saying after the rally we've had, I think it makes sense to be open to some volatility, maybe a little bit of weakness this August. A year ago, right about now, is when the yen carry trade unwind started, and we all remember going to bed that one Sunday night knowing Japan was having its worst day since '87. That was pretty uncomfortable and honestly pretty scary for a lot of people. It came out of nowhere. For whatever reason, August tends to have these events kind of come out of nowhere on light volume and then a lot of volatility. So let's just kind of buckle up. It might happen again, but this is still a bull market led by an economy. Global economy is pretty good with earnings. So if we have some weakness, it's all part of the plan, and let's not panic, but just get ready because August seems to surprise a lot of times.
All right, looking forward to August and all that brings. We've been in conversation with Ryan Detrick. He's the Chief Market Strategist for Carson Group. Ryan, always a pleasure having you on the show. Thank you so much.
Anytime I can talk with another Ryan, it's always fun. But thank you for having me. I look forward to joining again very soon, and everybody have a great day.
You too. Catch you next time. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.